middle. To date, the commission has released 2 proposals regarding 2 of those. I'm not going to discuss those today. Shortening the settlement cycle, the plumbing, and also enhancing short sale disclosures. A third thing in that report from last year was about digital engagement practices, what some people might call gamification. We put a request for comment out on that in the fall. Today, I'd like to focus on the 4th aspect that was in that report, and that was about trading in dark pools and through wholesalers. We have not updated key aspects of our national market system rules, particularly related to order handling and execution, since 2005, 17 years, a lifetime in equity markets, and even, Rich, for you, a lifetime in Piper Sandler conferences. I think then it was Sandler or Neal conferences, but maybe it was a firm even before that for you. So last year, I asked staff to take a holistic, cross-market view of how we could update our rules to drive greater efficiency in our equity markets. Helps investors, helps issuers, if the middle of the markets are more efficient. That which you cover each year in these conferences. I'd like today to discuss work across 6 areas: minimum pricing increment, national best bid and offer, disclosure of order execution quality, best execution, order by order competition, and payment for order flow and related exchange rebates and access fees. So let me try to do it quickly because I know, Rich, you're going to have a bunch of questions. Minimum pricing increments. Today, we lack a level playing field amongst the different trading venues, wholesalers, dark pools, lit exchanges. There are many disparities between these 3, but particularly let me mention something about tick size. In the lit markets, investors see prices in 1-penny increments. We're familiar with it. Rich, you and I grew up when it was wider. Wholesalers, though, can fill orders at sub-penny prices and without open competition. It's not level. And more than half of the share volume in the first 5 months of this year was in stocks constrained by tick size. I'm talking about on these exchanges. And in contrast, sub-penny trading, including 1/10 of a penny, so 1/10 of a penny, accounts for 37% of the share volume executed off exchange. Given this activity, I really wonder why this lit exchanges should have that 1-penny constraint when the off exchange does not. It raises real questions about whether this structure is fair and best promotes competition. Why not allow all venues to have an equal opportunity to execute at sub-penny increments? Therefore, I've asked staff to make recommendations for the Commission's consideration around leveling the playing field with respect to 2 facets of tick size. First, possibly harmonizing the tick size across different market centers, such that all trading occurs in the minimum increment, regardless of market center. Second, given the sheer volume of off-exchange sub-penny trading, as well as the currently allowed on exchanges, retail liquidity programs go down to 1/10 of a penny in these RLPs, possibly shrinking the minimum tick size to better align with that which is happening off exchange. So that's first, tick size, leveling the field. National best bid, best offer. The NBBO, as it's called, is a quote designed to aggregate information across the different exchanges. It provides investors important pre-trade transparency, and then those shares are subject to what's known as the order protection rule. I've asked staff to consider 3 issues related to the so-called NBBO. And the question is really, what's included, what's excluded from the NBBO? Is it a good measuring rod? Is it not a good measuring rod? So first, the NBBO currently includes only what's called round lots, as you know, quotes of 100 shares or more, has for decades. That seems to leave out critical gaps. Staff calculations using trade and quote data found that odd lots, less than the 100, increased from about 15% of trades in 2014 to more than 55% of the trades in March of 2022. This has a lot to do with the transformational times we live in technology, and what's going on. It also has to do with some average share prices moving up. Retail investors, the very investors who are more likely to buy and sell at odd lot prices, are unable to see the prices. Sophisticated folks can see the prices of the odd lots more readily, but not the retail public. And in 2020, the commission adopted something called the Market and Infrastructure Rule, which was recently upheld in court, I might note. And this rule created a new round lot definition, which, depending upon share price, the round lot could be between 100 shares and 1 share, had increments. It also added odd lot information to what was called the core market data. So under the transition schedule, under that infrastructure rule, though, the implementation of the new round lot could take several years, maybe even many years. And therefore, I've asked staff to consider whether we go out, notice and comment rulemaking again, and accelerate the implementation of this new round lot definition. The infrastructure rule also included quotation information about the remaining odd lots, even those odd lots less than the 40 or 20 or 10 of the new definition of round lot. So I've asked staff whether we should consider also accelerating that information about odd lots into core data. Together, I think accelerating both of these timelines would allow retail investors to better understand prices sooner. But there's a third thing I want to say on this, is I've also asked staff to consider whether there should be an odd lot best bid and offer so that investors would know the best price available in the market regardless of share quantity. Third, disclosure about order execution quality. You might be familiar with a rule that's been in place for about 20 years that allows retail investors to understand and compare execution quality across these market centers. But today, retail investors cannot compare execution quality across brokers. Yes, for market centers, but not their brokers. And that's because this so-called Rule 605 only covers market centers like the dark pools, the wholesalers, and the exchanges. Moreover, the rule is 20 years old. So I've asked staff to make recommendations on how the commission could consider we might update this. 22 years is a long time in these markets, and that investors could receive more useful information that could include mandated that broker dealers, along with the market centers, file some monthly reports on 605, and further, that there be some consideration given to requiring all reporters, market centers and broker dealers, to provide summary statistics of execution quality, such as price improvement as a percentage of the spread. Fourth, let me talk about best execution. You might be familiar with it. Right now, the Financial Industry Regulatory Authority, FINRA, the MSRB, the Municipal Rulemaking Board, have rules on best execution, but we at the SEC actually do not. These FINRA and MSRB rules require that broker-dealers exercise reasonable diligence to execute customer orders in the best market so that their customers, not them, but their customers, receive the most favorable prices under those prevailing conditions. I think investors might benefit if the SEC also considered proposing a rule about best execution. And in addition, broker-dealers and investors might benefit from more detail around the procedural standards. See, FINRA, MSRB, 22 years later, there's been a lot of questions. So why not provide better details on procedural standards brokers must meet when handling and executing customer orders? So I've asked staff to consider that as well. And not just for equities, but for other securities. Best execution, whether it's in corporate bonds or elsewhere. Fifth, got a little press, I guess, this week. Order by order competition, I want to talk about. Competition promotes efficiency in markets. We know that, but it also sort of takes away potentially some economic rents or excess profits above market competition that might otherwise accrue. And yes, Rick, it might be some of the people in the audience. There's a trade-off. Investors and issuers benefit if there's less economic rents in the middle, and there's sort of the full benefits of competition transparency in the middle. So as I've mentioned, the vast majority of retail marketable orders are flowing to wholesalers, plus 90% to a small handful of wholesalers that pay for order flow. And what's more, this segmentation means that institutional investors, such as pension funds and others, don't get to interact directly with that order flow. This segmentation, which isolates retail market orders, may not benefit the retail public as much as orders being exposed to order by order competition. And some have suggested, I've heard it, that the segmentation with the isolated segmentation allows retail investors to receive slightly better prices compared to the NBBO. But as I mentioned, the NBBO is not a great measuring rod. And what's more, this price improvement doesn't say that that's the price improvement that would be available with full order by order competition. So it's not necessarily the best price. It's just price improvement versus actually a measuring rod that's got a lot of gaps in it and doesn't necessarily have the full benefit of order by order competition. So I've previously discussed the NBBO, but in addition to that, I've asked staff to make recommendations for the Commission's consideration around how do we enhance order by order competition. Now, this may be through open and transparent auctions or other means. It may be saying that investors get the midpoint or better, and then there might be this auction mechanism. If not, we know that the listed options exchanges have operated auctions for retail orders for many years. I've asked the staff in consideration of any recommendations for cash markets, stock auctions, to draw upon the lessons from the options markets and focusing on how do we assure full competition amongst all market participants to provide the best prices for retail investors. Last, let me close on a topic that's probably also gotten a fair bit of discussion, payment for order flow, and I think the related exchange rebates. And of course, there's access fees related to that. Payment for order flow can raise real issues around conflicts of interest. Exchange rebates can as well. As described in the Commission's settled enforcement action against Robinhood in 2020, payment for order flow can distort routing decisions. Certain principal trading firms seeking to attract Robinhood's order flow told them that there was a trade-off between payment for order flow and price improvement for customers. And I would note, not all brokers pay for order flow. And many have said, well, what about zero commissions? There are zero commission brokers that are not paying for order flow. So zero commission doesn't mean zero cost to the retail public. And it comes back to how much of the price improvement is being shared with the retail public versus staying with the wholesalers in the dark markets. So as the staff reported in the GameStop report, payment for order flow may incentivize broker-dealers to use digital engagement practices, another project of ours, gamification, to increase customer trading. The European Union is actually actively considering banning payment for order flow, joining other regulators from the United Kingdom, Canada, and Australia. Exchange rebates, as I said, also present conflicts because exchanges give rebates to traders, and in particular, high volume traders benefit more from these arrangements than lower volume traders. And we often talk about high volume price discounts, but here we're getting a lot of orders routed through the biggest market players that small brokers are routing through large brokers trying to get some of that discount, and the large brokers are getting to see that flow and getting discounts and the like, leading to greater concentration, I would note as well. So just like payment for order flow presents a conflict, routing of marketable retail orders, exchange rebates may also present conflicts. So thus, I've asked staff to make recommendations around how we can mitigate the conflicts with respect to both payment for order flow and rebates. And one thing I've asked them to consider is whether exchange fees, what somebody pays to access the quotations on the exchange, And rebates should be more transparent, just making them even more transparent so investors can understand these amounts at the time of the trade execution. Finally, I've asked staff to consider how the access fees might change in light of the potential lowering of minimum tick size. Minimum increment, a penny. Access fees right now, 30 mils or 0.3 of a penny. That proportionality, what should happen with that? If we reduce the minimum pricing increment, it may also be appropriate to reduce these access fees. Of course, that would relate to these rebates as well. So let me just say, Rich and audience, in conclusion, I think we at the SEC need to look for opportunities to freshen up our rules to ensure that America remains the gold standard of the world's capital markets. Nothing stands still. Technology is rapidly changing. And so we can't take our leadership in capital markets for granted. And we really fundamentally haven't updated our rules since 2005, other than the infrastructure rule and data that I mentioned earlier. And as they continue to change the face of markets, technology, business models, and like, we have to look out for the investors on the one side and the issuers on the other, and particularly retail investors, as there's more retail investors in the market than ever before. It's not clear, given the current market segmentation, concentration, lack of level playing field, that our current national market system is as fair and as competitive as possible for investors. I think we can do better here for retail investors. I thank you. And Rich, I turn it over to you.
First, Chair Gensler, thank you for addressing my audience here. What you just outlined is certainly impactful to a number of the wholesale brokers, exchanges, and e-brokers that are present. And I also just want to commend you for your commitment to keeping rules up to pace with the technology, which we know there's been a lag. So with that, I'll get into a few questions here, if you don't mind.
Absolutely.
First, you've outlined sweeping changes, which we just heard. And in equity market structure, you've emphasized this order by order competition. So could you give us a better view of what that order by order competition might look like? And then also, what wasn't expressly clear to me is payment for order flow prohibited, or would payment for order flow still be able to exist in this order by order competitive environment?
Look, I'll say this, Rich, I don't want to get ahead of my fellow commissioners or the staff. I thought it would be helpful, seeing that you invited me to this speech, to sort of put out there what we're considering. So on the order by order competition, it's really what I've asked staff to focus on is for retail marketable orders. How can we inject greater competition so the segmentation is not isolated segmentation? Right now, 2-3 wholesalers are buying that payment, buying that order flow, not competing order by order. Yes, there's some price improvement, but not as much as you can see in these 605 reports and other reports in terms of the realized prices in the market. And so injecting greater competition through an auction mechanism, learning, of course, from the options, what works, what doesn't work in the options markets, and other groups of staff are actually thinking about possibly what to do there. But I don't want to get ahead of that. In terms of payment for order flow and rebates, as I say, they present inherent conflicts to the market. 3 other jurisdictions and a 4th, a big one, Europe, is considering getting rid of them. So I continue to ask staff, what should we do there? But as we put this all together, we're going to put it out to notice and comment, and obviously hear from the public as well.
Understood. Thank you, Chair Gensler. The next is many, and you sort of alluded to this, many regard the U.S. retail markets as highly efficient and even the most efficient in the world, what some would say. So I guess the question is there any data to suggest that the auction process will be better or result in an economic benefit, or do you plan on doing any pilot tests? And just one last part to the question is, are you concerned that it could have an impact on the low pricing and nil pricing that the e-brokers charge?
Let me just say this. I think it's misleading. There's a cost to retail to this current system. And the cost is that 2 or 3 highly concentrated market makers are buying your order flow. And though there might be some price improvement against a false measure, a poorly put together measuring rod, NBBO, that doesn't mean it's a full price improvement. And it doesn't mean that it's best execution. So I think if we put in our rule set, not just FINRA's, our rule set, and put some procedures around best execution, we consider put out to public notice real auctions. So it's still segmented retail flow. But Rich, think about everybody on the other side, institutions that currently cannot access that retail flow. Is that the best capital markets? And so that's what we're going to put out. And yes, we'll put it out with economic analysis. Yes, we'll look forward to the public weighing in with their economic analysis, and we'll have the lively debate.
Understood. A little bit on the same sort of questioning line would be, what is the timeline? We've heard the broad outline by you, but I suspect, you'd have to go to proposal, comments. So what is the real timeline behind what you're suggesting? And then would you be open to a roundtable to discuss, this is some highly controversial topics. Would you be open to a roundtable discussion, which the SEC has held in the past, and which
Rich, let me just say this. There's lots of ways to get public input. We're doing it all along. Anybody who's listening to this and watching this, let us know what you think. This is not a proposal. This is a chair's speech. I'm not speaking on behalf of the staff or the fellow commissioners. I've said that up front. I really mean it. But weigh in, talk to us. When we put a proposal out, we have multiple ways to engage with the public. I feel that as a chair of this, it's a remarkable privilege to be chair, but I give speeches. I sort of lay out something. I try to say what we mean and mean what we say. We had a GameStop report last year, and we got a lot of comments in on that, informally and formally and so forth. So continue to engage with the remarkable staff at Trading and Markets and Division of Economic Risk Analysis. And of course, engage with individual commissioners as well and their offices. And if we get to a spot where we propose something, I can't prejudge that, but if we get to the spot where we propose something, we'll hear more. And whether it's roundtables or meetings, it's really important to get the public's input.
Thank you, Chair Gensler. One last question on equities. And if you don't mind, I have a question or two on crypto as well as fixed income markets as well.
Gosh, I figured as much, Rich.
It's in my allocated time, though, Chair. So first question, just last question on equities. You mentioned the SIP infrastructure proposal, that was upheld by the courts, the DC courts, and that you'd pick one, I think it was the odd lot, about publication of odd lots. So what do you expect to implement the SIP infrastructure proposal in the broader outlines over the next year or so? Right?
Rich, I don't remember the exact dates that are in that rule, but it's now been upheld. Of course, the litigants will have to decide what they do, but there's a various serious that was a unanimous vote, by the way, at the commission 2 years ago, and it was to. It's basically similar to what I'm saying here. It's how to use the benefits of competition to drive greater efficiency in our capital markets. That was competition a bit around market data and driving some efficiency in that infrastructure rule. But you're right. I did mention two aspects. The definition of round lot and the inclusion of odd lot data and core data that I've asked staff, should we go out to? Again, it would be notice and comment rulemaking, but notice and comment to accelerate those two aspects earlier, along with the other potential reforms I'm talking about here.
Great. Thank you on the equity. Now, if I could follow up on crypto, these are general questions, Chair. So just recently, a bill, I believe, has been floated by Senator Loomis of Wyoming and Senator Gillibrand.
Senator Lummis.
Lummis, excuse me, and Gillibrand of New York, sort of broad outlines of regulation for crypto. And I guess the question is, first, what's your broad impression? Second, just, if you can't answer that, which is doubtful, but what's your overall view on the need for regulation in crypto? And then how well the bill, from what we understand, divvies up responsibilities of regulation to both the CFTC and SEC. How well do you think you can work together to actually execute on regulation of crypto?
So there's a lot you packed in there, and I've had good dialogues with Senator Lummis, and I've known Senator Gillibrand for years, and certainly worked with her very closely in the Obama years. But whatever comments I might have, I'm going to share with them, not with you and your audience now. And I really haven't reviewed their bill. It was released yesterday. But let me go to a broader sense. Crypto, this speculative asset class, $1.25 trillion roughly dollars right now, does not have the investor protection that the public needs. And I would contend, if this field has any future, what the field needs as well. And there's three sets of big public policy issues. It's investor protection, which the Commodity Futures Trading Commission and the Securities and Exchange Commission is kind of, our domain. I'll come back to that question. There's the issues of financial stability and money creation around stable coins and the like, that the banking regulators, Treasury, we have some role in that as well, because many stable coins look like money market funds. Many algorithmic stable coins, really are under our Howey test, very similar to, securities or our investment contracts, what it's called. And then thirdly, illicit activity, and how we guard against the use of these coins to circumvent the public policies around sanctions and illicit activity and ransomware and the like. So there's a lot going on here to unpack, but I would say most of the tokens, thousands of tokens, have an entrepreneur in the middle, or a group of entrepreneurs in the middle, raising money from the public, and the public's anticipating profits based on that. That's the core of a definition of an issuer-based securities regime. That's what the SEC was asked to do in the 30s, painted with a broad brush, Thurgood Marshall's words, not mine, to protect the public against sham and fraud. I had the honor to chair this CFTC, another great agency focused on derivatives, and particularly derivatives around commodities and so forth. Ours is an issuer regime, protecting the public when a group of entrepreneurs should disclose something to the public. And you're a research analyst, Rich. You know how important that disclosure is. And to get that disclosure, make sure somebody's not, lying to you, defrauding you, not trading on insider information. That's what we do well at the SEC. And so most of these tokens are actually, right now, I'm not prejudging any one of them, but right now, they're investment contracts, they're securities. And thus the trading platforms, the ones that you cover with great interest, some public, some private that want to be public, those trading platforms should come in, work with us. I've said this publicly, we're willing to think through how to use our exemptive authorities. And basically, we've got these projects: registered crypto markets, registered crypto intermediaries, and yes, registered tokens. We are also looking very closely at the stable coins because, frankly, they look a lot like funds and how they're operating. And guess what? They're offering yields, and sometimes they call them rewards, sometimes they call them yield. That's a return on something. So we've got all these projects, but Chair Benham and I have talked off and on about how we do something, enter into a memorandum of understanding, because some of the tokens are commodities, Bitcoin being one of them. So there's a lot here to work with the bank regulators, work with Congress if appropriate moving forward. I know I went on a little bit.
That's fine, Chair. If I had to echo anything from the management teams of the crypto companies that presented here today, they just want clarity from a regulatory
Well, it's good. If you want clarity, I say this, and I can say your first names pretty well, but I won't because I'm always told not to. But I know most of you, I've met with most of you, is work with us, come in, because otherwise it's just, you've got securities floating on your platforms and you're right now operating outside of the law. And that's what we have a robust examination and enforcement units. It's half of our staff at the SEC between exams and enforcement. But work with us and think this through. And I will say this also, some of the traditional incumbent exchanges that are not yet there, they're working with us. So the crypto exchanges that are potentially operating outside the law, it'd be better to work with us too. And I think you'd want to say that as a shareholder, Rich.
I would probably agree, Chair. So last sort of category of last question, I might have one follow-up, of course, but in regards to fixed income, in a recent speech, you outlined, how big the fixed income markets were, how important they were, in comparison to the equity markets. And, you highlighted post-trade transparency, the platform reforms, and resiliency. I'll keep this at a high level, but what was you outlined reforms in each area. We won't get into detail here, but what's your overall goal in trying to regulate, the fixed income markets?
So I put it in a nutshell. I've been blessed to serve now 3 presidents, and it's a remarkable privilege. I'd like to be able to look back and say we made our capital markets even stronger. And I think of it in terms of efficiency, that in the middle, how we price and allocate capital and risk in our system. It might sound geeky, it might sound a little bit finance oriented, but unless we do, Rich, other countries will surpass us. It is part of our great success as a nation. We have a rule of law. We've got an innovative population. We've got so many great attributes. But one of the great attributes is this system of what I'll call transparent, regulated markets. And I think it's part of our geopolitical success, but I wouldn't take anything for granted. And when you see concentration and segmentation and lack of level field, as we see in the equity markets or over in the treasury markets, that we see so many times our central bank has to come in and basically hold kind of what I'll call the left tail risk, the risk that the market has jitters. And we had it in 2020, we had it in 2019, we had it in 2014. If you watch your history, you can find 3 or 4 events in the early 80s. You can find event after event. Can we make that market, the treasury market, more resilient? And then in the broader fixed income, more transparent. And so, yes, we've been working with FINRA and trying to revise the trace reports, not only to be shorter and more timely, but also to inject more relevant detail in the corporate bond market. And yes, working with our colleagues at the Treasury and the Federal Reserve about post-trade transparency in the Treasury market. But the single thing that sort of animates me is in this honor to be in this role is how do we sort of, in a rapidly changing technological world and a lot of global competition, how do we ensure that our capital markets in the middle has fewer economic rents, greater competition and transparency and efficiency, that the buy side can compete with the sell side in those fixed income markets and really compete? We get the principal trading firms, the high frequency trading firms, so to speak, registered so that but once they're registered, then there's more of a way they can compete in the middle, even with the prime, what's usually called the primary dealers. I went on a little bit, but it's all about trying to drive greater efficiency in a geopolitical competitive world.
Thank you. One last follow-up on the equity markets, because someone has brought this question to me. Would the auctions cover or preclude, say, large banks that have internalization of orders that internalize a customer order with their own trading desk? Would they be included in this auction?
Again, I'm not trying to prejudge the staff and where we might come out and everything, but I thank whomever asked the question for the question, and I don't want to prejudge that. I want to thank you again and all your audience. I want to thank you because I know that you didn't start in a career in finance. You started at West Point, if I remember, and but we both went to Wharton. You're very analytic. We're analytic. We're going to look at the economics, and the reason I'm closing this way is we benefit if the members of a conference like this give us feedback, give us input. If we actually put something out on the equity markets, give us feedback. But of course, we've already put out a lot of things on the fixed income markets. We've put out things on shortening the settlement cycle. Give us feedback. Economic ground truths really help. Know that we have a little bit different role. We're representing 330 million Americans. You're representing your clients, your customers, your shareholders, frankly, your revenues. So we might have a little bit different perspective, but we really do benefit from the hard analytics that a guy like Rich Repetto is so good at, and the economics matter.
Chair Gensler, I want to thank you for your commitment to transparency. Thank you for your commitment to keep investors, there be plenty of debate, but keep people informed. What I would say, Chair Gensler, and if I respectfully call you Gary.
They call me Gary, of course. You have for years.
You've been a force as a regulator, no matter what job you had. So you've truly been a force, and I respect that. And I think there'll be debate, but we respect, your effort and the time you put in to try to get the things done, to execute on your job as the SEC commissioner.
I don't know. You're. Thank you for the compliment. It was probably Sam and Jane Gensler's work, and you might know I'm one of 5 kids, and I've got an identical twin brother, and it's just you had to be fast around the Gensler dinner table.
And a former MIT professor of crypto as well. So
anyway.
Thank you, Chair Gensler. We appreciate the update, and hopefully we'll talk to you soon. I won't ask the question, will you come back next year? We just hope to talk to you again soon.
Rich, I know what it is. You always want me back if I'm still in the job. But like 6 years from now, will you be asking me back?
No, that's not true. I did ask you when you were at MIT as well. So I believe that when you were a professor. But thank you, Chair Gensler. We appreciate your time.
Thank you.